Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for September 13th of 2021. Please see our disclaimer for important information. Well, all right, as we get started in the chart pack for the week, we have a brief coronavirus update. Got a couple of charts here and have one to follow before we transition into the economic data. First and foremost, I want to call your attention to what we see here on the left-hand side. And this is a 7-day moving average of daily new positive cases as well as daily reported deaths. You've seen this chart a lot over the last year, and you can see that there is a rolling over in the 7-day moving averages. I mean, rather pronounced. We were beginning to notice this several weeks ago. And now it's beginning to really take form. Of course, if you go back to the end of the year, there were several false peaks, so we want to guard against that. But the trend line really looks good right now. Obviously, continue to monitor, and obviously Delta wave continues to be an issue with infections. There's still a lot of entities that are taking precaution, and clearly it's still having an impact on consumer behavior, but I think as we monitor this, that issue will begin to wane here as we head in a little bit deeper into the, at least as we commence the fourth quarter, at least. And then on the right-hand side, you can see on a regional basis, obviously the South was a real hotbed of infections, and you can see that that clearly is rolling over. And really every geographical location here in the U.S. is witnessing a deceleration, if you will, in caseloads. Here's a quick chart from the CDC on adolescent infection rates, and a lot has been made about this too, because we now are several weeks into the school year, and so we can measure, the infection rates. Although arguably there's been significant gaps in the amount of data collection that has been done. And there are a lot of reasons for that, but at least here on the CDC's data, you can see the uptick relative to the end of last year. And so what's interesting here is so much has been made about the increase in adolescent infection rates, and that's obviously taken place, but relative to where the infection rates were at the end of last year, I mean, we're really not there. I mean, 12 to 17-year-olds were higher. We have seen a higher incidence of infection on the 5 to 11-year age cohort, which obviously was, I think, prompted in some respects by the opening of school. But again, on a relative basis, looking even to the end of last year, it's not as exaggerated as some might have you expect. All right, we'll transition to some of the surveys and some of the economic data here. Here's the Evercore ISI company survey. And so this is where I guess the trepidation or anxiety over the Delta wave is kind of manifesting itself. So this is a survey of retailers, auto dealers, as it says here, home builders, restaurants, etc. And so you can see here that this composite has clearly rolled over, albeit at a higher level than we even saw pre-pandemic. So we've had this massive recovery, and I think in many respects we accelerated well past where we thought we're going to be, and so now we're seeing a bit of consolidation here, and the Delta variant emergence really just kind of served as a catalyst for some of these respondents to become perhaps a little less optimistic, or maybe a little bit more guarded is probably the better way to put it here. But again, nothing that we need to necessarily worry about, but we're just observing this trend kind of roll over a little bit. Here's our weekly high frequency data that's provided to us from a lot of different sources, but compiled by our friends at First Trust. And for the first time in several weeks, again, owing to this thought that as the infection rates begin to decelerate on the current wave here, that we're going to see a transition into more positive data, or at least less negative data. And that's certainly the case this week. So as we look at TSA checkpoint data, obviously the monthly numbers do not look that great because we've had some pullback and we've had some seasonal transition as well. As we get back into school, there's less travel overall, so on and so forth. But we did see a nice uptick last week. Also saw an uptick in motor gasoline sales. And we look at hotel occupancy, that still remains fairly weak, and steel production is weak. We continue to see more positive information overall on the labor front and staffing. Again, so we're beginning to see a little bit of a transition in the data. Happy to see that and probably expect that to continue, although the data may be a little bit choppy here over the next month or so. Here's one chart that I thought was real interesting from Earnest Research. It's a measure of foot traffic in AMC movie theaters, and so this can be rather lumpy. Obviously, foot traffic is somewhat dependent on new releases and hot releases that everyone wants to go see, etc. But you can see the general trend line. Although we are still about 40% below in terms of foot traffic relative to 2 years ago, relative to 2019, it is improving. So good news here. Here's weekly retail sales, which, if you look at that deep blue line, it's tracking well above even 2019. So obviously we've had a lot of benefit to durable goods. We're beginning to see a bit more in the service sector as things have reopened, even though that probably is the reason behind the latest downtick in retail sales. But again, relative to 2019 and certainly relative to last year, it looks really good. Here's a quick check-in on truck and auto sales, and not too surprising, you can see that the forecast is looking pretty dire for this year. And we saw a huge dip during the pandemic. And by and large, we've seen for several years this, the sales figure that's kind of been saddled in the 16 to 18 million unit category, or level, I should say. And, now we're trending down perhaps to 13 to 15. And the last data point that at least is forecasted by J.D. Power and Associates is around 13 million. So we see the impact of supply chain choke points. We see the impact of semiconductor shortages. There's a lot of vehicles that are parked in various stages of production at various large open lot locations. They're just, they're about 90% complete, but they're missing all their semiconductors. And we're seeing that in a lot of cases. But here, auto and light truck sales are expected to be materially lower than the trend line that we've experienced over the last several years. Here's a quick look at non-revolving consumer credit owned and securitized relative to revolving credit. And so the key takeaway here is that you can see that revolving credit owned and securitized is just a function of new credit card purchases essentially. And so you can see that number is trending a little bit higher after having troughed earlier this year, and trending up is a net positive for the economy. We see consumers taking on a little bit more leverage, obviously here with credit cards, that this will benefit economic growth because it relates directly to consumption. And on the mortgage front, and as it relates to the health of the consumer and the spending capacity of the consumer, I thought all of this information was really, really interesting. So there's no doubt that housing prices have gone up. We know that. We know the impact of that. We know what kind of dislocations it's created in the residential real estate market. But here's kind of looking at it a different way. It's both charts on the left-hand side really represent the borrowing capacity, if you will, out of one's home. And so homeowners essentially have trillions and trillions of dollars of what they call tappable equity. And this comes from Black Knight research. And so there's trillions of dollars of tappable equity that can be utilized. Again, that's not to say that that's liquidity that can be spent right now, but you can tap it. And as long as we have a constructive uh, mortgage market with relatively low rates and relatively easier credit, then one would think that that there will be some benefit from homeowners continuing to tap the equity in their homes. And as you can see in the bottom half of the left-hand side, that number, that amount of equity has gone up tremendously over the last year. Now on the right-hand side, this is house prices relative to income per household. And so this is just another way of looking at the home price appreciation factor, but in a little bit more of a relative way. And you can see here that house price appreciation has far outpaced household income, which again goes directly to this thought of accelerating consumption by virtue of taking taking equity out of one's home. I thought this chart was really interesting from Castle Systems doing an analysis of the commercial office market. And we've seen the huge change and the decrease in occupancy as things were shut down, and this gradual recovery. And even as Delta has kind of come back to the front of the headlines, we've seen some firms further delay bringing people back into the office, or frankly, just sending them back home because of this. And you can see where the occupancy rates by metro area, just close to home here, we've got Houston that is just really struggling to get above, like, say, 45%. And that number was, in the mid 90s pre-pandemic. So really dramatic here. New York, San Francisco, not too surprising. Those remain very low, even though they have improved. And then the gray line represents the average of the top 10 metros. And you can see that the top 10 metros are really struggling to get above 30 right now. And that is really profound. It's going to have a meaningful impact here on the future of office and the future of non-residential construction. Going through some additional research on household balance sheet strength and the strength of families financially, I came across this. This is net household liabilities as a percent of disposable income. And looking at this on a trend line basis, dating back essentially to the end of World War II, you can see, that we've really round tripped this in terms of the movement here. And liabilities have gone way down. So it's interesting at a time where we're beginning to see increased credit card debt, that overall household liabilities as a percent of disposable income, frankly, has gone down. So the consumer remains healthy. This type of data point leads me to think, again, we've had recessions even as this ratio has gone down. But I think overall it does speak to the long-term health of the consumer, which, as we know, is about 2/3 of our economy. So if liabilities are going down, tappable equity in that previous slide is going up, then that gives me some comfort for some staying power, that it prevents what I would otherwise think is a major recession, barring a massive policy mistake. Quick check-in on margins, and these are non-financial margins, and how it ties back into producer prices. And what's really interesting on the right-hand side, I'll start there first, is that we had Bank of America compile this data that comes from the Bureau of Economic Analysis and Haver Analytics, but basically we haven't seen non-financial corporate profit margins this high in decades. I mean, literally dating back to the Vietnam War era. And it's really interesting. And what we see is happening here right now, and obviously we've got input prices that are higher, and even though they've come off their peaks, there's still an issue. But there's increased pricing power on the part of producers now, and so they're pushing that through. So even though we're seeing high core PPI, which is producer price index, that's over there on the left-hand side. And so whether it's you back out the the trade services, I mean, that number is still elevated relative to what we've seen over the last several years, and we know that. That's not a surprise. But despite that, we're still seeing ultra high profit margins. And so that is a clear indication that even with higher input prices for producers, that they do have pricing power because they're still getting the margins. Now, we just got through mentioning the continuing issue from input prices into the production channel. And amongst those cost inputs are commodities in a lot of cases, industrial commodities. And here is an example of one of the issues that's going on. You've got industrial metals prices that still remain pretty high. And so this chart, if you look at the top part of this, you see that spike. And that's, that's been in development for, the better part of year and a half now. You can see the momentum indicator, so those price increases are beginning to decelerate. That's what that middle part of this chart represents. So the momentum indicator is beginning to slow, and so it's not as overbought as it was here previously, but it's still very, very high. But here's the thing that this particular research highlighted, and we've talked about it both here in our slide, in our charts of the week, as well as market minutes, is that China's manufacturing indices are slowing. Now, they've had Delta issues. I mean, there's a few things at work, but basically Asia's been impacted on the manufacturing sector. And you can see that here, and that represents a flag to a lot of different things. So if China slows down, then there's impacts on demand for a lot of different things, not the least of which is industrial metals. So you could see a shift in prices, an increase in supply, and maybe a breakdown a little bit in some of the commodity baskets that would be impacted with a Chinese slowdown. So we're going to have to monitor that, but clearly the Chinese Manufacturing Purchasing Managers Index is something that bears a lot of scrutiny over the coming weeks. Now, as we kind of shift from producer price issues into consumer price issues, one thing that we've been talking about is, to what extent are these price increases that we witnessed in a profound way earlier this year, are they transitory? And so some of these prices seem to be, beginning to either crest or, perhaps decelerating or, lower accelerating prices here. But, with this chart coming from basically data from the Commerce Department that's kind of republished here in some Goldman research, is pretty interesting. So, basically, we see in issues and things in the market like cars, rentals, so on and so forth, appliances and furniture that represented a huge price push earlier this year. And frankly, because of supply chain choke points, the commodity price inputs were higher and these were being pushed along to consumers. We've talked about that. So all of these costs are going up for folks. But the interesting thing is in this analysis, and I think there's definitely some truth to this, that what has been a headwind for inflation, meaning inputs to drive inflation higher, when you anniversary those increases, then they are very likely to become tailwinds, meaning that it would be disinflationary to some extent. So I think the net of all this is that, what is really hot right now in terms of price increases is going to be less so next year. And so this chart kind of, as you scroll from left to right here and you get into 2022, this is really the argument that's being made that we're not going to have the inflation next year that we have this year. The elements of this are indeed going to be transitory. The question is, where does the inflation rate end up? And so basically you're offsetting all of the inflation from some of the COVID economic reopening kind of things that we've been talking about here that you see in this legend, those things are going up this year, but they're going to settle out and maybe even soften a little bit next year. All right, well, we're going to transition now into the shipping sector, and most notably here, container shipping. And even as we've seen numbers on consumer spending, consumer growth, the health of the consumer, all of that trending positive, we do have these bottlenecks, and they're not going to go away overnight. And whether it be shortages of certain components, we actually have a lot of clog in our ports, a significant clog. And I got two different representations of that here. So on the left-hand side, you've got the number of anchored container ships that are sitting in or at or near LA Long Beach, which that port on the West Coast is one of the largest in the world. It's certainly one of the largest in this country. And you can see this pronounced spike. And this goes back basically a little bit more than a year. And you can see that we had choke points at the beginning of this year, and we've essentially eclipsed those in terms of the number of ships, the aggregate number of ships. And I think, one thing is for certain, you don't want to be, speed boating in the Pacific Ocean off of Southern California at night for fear of hitting one of these, 40 or so ships that are anchored off Long Beach. That number is actually represented on the right hand side, this right chart. And so this is a much more narrow look. This is essentially 1 month to kind of show you this continued increase. And it's not just Los Angeles and Long Beach that's impacted here. You can see the increasing amount of clog in the ports of Savannah as well as New York, New Jersey, all contributing to this continued rise. Again, product not getting to where it needs to go. And so in a lot of cases, retailers are not stocked very well, empty shelves, or your lead times for products are very long, or, and then this is all just driving cost higher and higher and higher. And actually, to that point, here is a container freight benchmark rate on the left-hand side. And this is basically, dollars per 40-foot container. And you can see here that they spiked to 10,000. And if you look over essentially a 10-year period, you can see just this tremendous increase. It started last year and gained a lot of steam earlier this year. And that number continues to move higher because we've got all of this clog in the system. And so, why is this significant? Because it's going to wind up in the prices that you pay for everything from apparel to consumer goods to everything else. This is too significant a jump for people that sit in the middle of the value chain to absorb. And so it's going to have to get passed along. You can see on the right-hand side, it looks like a very, very similar chart, but what this actually represents is the amount of container ships that are being produced that are coming out of China, which is the main producer of containers, of just containers. So just to rephrase, these are containers that are being produced. And so obviously the rate of production has gone up, but it's not keeping up with the demand for containers right now. All right, a couple of quick looks at various things. Here's North American hot rolled steel. Steel prices continue to move higher. Again, there's a demand for durable goods, which require steel. So really, where we've seen abatement in some other areas of the industrial commodity basket, we still see just increasing trends in cost for hot rolled steel. Crude oil production. Just a quick look back in on this, because we just had a hurricane that made landfall, and every time you have this, and every summer it's kind of a crapshoot as to what the storm situation is going to look like, because a lot of these rigs offshore get idled, and a lot of production is coming from offshore. So it is important for us to monitor. You can see our pre-pandemic peak of around 13 million barrels a day. And so that, drop, and then we've seen several issues that kind of played into this, like the Arctic blast earlier this year. Now, Ida has kind of brought our production level back down to about 10 million barrels a day, or essentially a little bit more than 30% off our peak. But hopefully we'll get more production online, because right now this is driving gasoline prices higher and keeping them, frankly, as high as we've seen them for quite some time. But it's also going to continue to drive higher costs for all of the distillate, kerosenes and things like that. So costs of transportation, cost of shipping, overland freight, all of those things are going to be impacted by lower overall oil production, which will keep energy prices high. Worldwide M&A, we've talked about this a little bit before. This is published in the Financial Times, but again, not a real big surprise here. We know that M&A has been really high here in the U.S., but this is a representation of what's going on globally. And you can see technology has an impetus here, financials and maybe real estate to a lesser degree, but overall M&A is really robust. So there's a lot of liquidity in the global marketplace that are chasing deals, chasing properties, chasing operating entities, and so on and so forth. And you can see that really manifested here. Job openings, we've made note earlier that the labor market is continuing to improve, and we've seen some really good data in the labor market really in the last month or so overall. And here you can see job openings are moving higher, really spiking higher. So there's a lot of opportunity. You can see the unemployment level on the right-hand side relative to job openings really trending in a pretty aggressive way. And so essentially there's 5 job opportunities for every 4 unemployed workers. And so, there isn't a reason in this data why we shouldn't continue to see further progress in the labor market, because openings are there. Again, it's a matter of finding the match between the skills of the unemployed versus the skills required in these job openings. But the net of all this is the labor market. This data right here gives us some comfort to project that we're going to have continued improvement in the labor market. And as we move into the investment markets, one thing that really caught my eye here, and we've been watching this for some time, is the relative valuation of small caps. And we haven't seen relative valuations to the S&P 500 index this low in 20 years. And it just continues to get lower and lower and lower. And so, as a result, we are certainly advocates of increasing or adding some small cap exposure, because, the valuations on a relative basis are really attractive right now. Here's a quick check-in on really the breadth of the market. And as we've seen some selling here in the market, and I think some consolidation, what we're seeing is that we have fewer companies that are trading above their 200-day moving average. And while this might sound a little esoteric, but having moving averages go higher over time, if you have stocks that are trading above that moving average, I mean, that's a pretty healthy sign overall. But when you have basically 95 to 90% of the whole market trading that way, I mean, that's really optimistic. That means you're continuing to move higher than your moving average on a continuing basis. And when you see this number dip like it has now, particularly in the last month and a half, almost 2 months here, in the way that it has, it's actually a little more comforting, because we want to see a little bit of divergence. Now, obviously, we had a lot of companies in the aftermath of the pandemic and the shutdown that went well below their moving averages, and so we've seen that number pick up over time. But something that you see like maybe in the 60, 70, maybe 60 to 80 range, if you will, is actually not unhealthy for the market. It just means that that we're kind of separating, and there are winners and losers, and not everything is moving together, which is not necessarily something that you always want to see. All right, and actually to that end, and some of this, market bifurcation, we've seen some leadership earlier this year out of companies that pay strong dividends, and as we've mentioned several times, coming out of the pandemic, I think the recovery was faster than expected, and a lot of S&P 500 companies that had curtailed or even ceased paying a dividend for a period of time, made it known at the end of last year that they were going to ramp up their dividends this year. And so, not too surprisingly, a lot of those companies in that boat caught a bid. And so we saw the dividend companies really kind of outperform the overall S&P 500 average. Now that outperformance has actually rolled over a bit, as we've seen dividend payers almost really underperform over the last month or so. And if you look at really the subgroup of high dividend payers, I mean, they are trading at a better multiple. So there is an argument for better overall value in the dividend paying companies than in the overall market. And as you can see here, this inflection has almost created an opportunity for us, I think. This chart is really kind of a relative indicator of sorts. So it's really measuring the equity risk premium that exists in the market. And that's a fairly esoteric term, but in its most simplest definition, it's the earnings yield minus a 10-year treasury yield. And as you can see here, on this diffusion index, if you will, where we are now is above the trend line. So stocks are more attractive because rates are so low right now. Yields on treasuries are so low, it does make stocks more attractive. And this is kind of the point that we've been making. As long as the Fed has got its foot firmly on the throat of interest rates at the short end, stocks are going to be attractive. And I think that's a big reason, aside from the liquidity argument, it's a big reason why stocks have done so well here lately. And frankly, I mean, this situation has persisted for quite some time. So really, if we know that we've been in this overall secular bull market for fixed income since 1982, with some fits and starts, but that just means that interest rates overall have come down gradually during that time, and rates are very, very low right now. And so consequently, over the last decade or so, we've seen this equity risk premium move higher, making stocks more attractive on balance. And so this is another reason why we saw a rather extended bull market, kind of uncanny bull market. And this has something to do with the fact that, with rates being so low, why perhaps we haven't seen these 5% corrections that we normally do, that are very, very commonplace in the market on any given year. But again, just the point to be made here is that by this measure, stocks remain attractive relative to fixed income. All right, and we have, from a valuations point of view, a look at the cyclically adjusted price to earnings ratio, and in various forms. So we have on the left-hand side, this is looking at, with the gray shaded areas being recessionary periods and going way back, like, essentially Great Depression, where we stand on the cyclically adjusted PE. Now, it peaked in 1998-99 in advance of the big tech bubble, when you really had a lot of companies that were high flyers that frankly didn't have any earnings, and so that number mathematically was going to be extraordinarily high. But here we're in an environment where we're in a rapidly improving economy that's going to find some settling out next year, but we're higher than we've been since that time. And so we have to pay attention to that. And the current value is about 26 times, and so we need to pay attention to that, even though as we looked at the indicator in the prior slide, I mean, stocks relative to fixed income had better value, but here we're just looking at it in terms of aggregate terms. Now, if you look at the right-hand side, you've got basically a forward 10-year annualized total return. As you look, and this is overlaid, against your margin-adjusted, cyclically adjusted price to earnings ratio. And if you advance that 10 years to say, well, what if, given that this is the case, what's the outlook for the next 10 years? And I think the prognosis by this chart is that equity returns probably aren't going to be as good because there is a pretty decent relationship here. And I think that, what this tells us, and this is not the first time that I've said this, that the expectation for future rates is going to be a little bit lower than what we've seen over the last 10 to 12 years. Well, as we close the chart pack for this week, got a couple of slides. This one happens to be kind of showing this transition from internal combustion engines to electric over the coming decades. I thought this was interesting. As we see, electric vehicles and hybrid and fuel cell vehicles really just kind of scratch the surface now. Fuel cells are extremely expensive, so we don't really see that yet, but you are seeing increasing penetration of electric vehicles. And so this chart just looks out to essentially 2040 to see what that looks like. And so I thought this was interesting because you're going to see more hybrid and and electric vehicles hit the market, which in turn is going to require an increasing investment in infrastructure to be able to support charging stations and things like that. Anyway, just an item of interest to me, and hopefully you find it interesting as well. And then the final chart that we have here today, this one really caught my eye, and I've been looking at the pace of technology spending at the corporate level, and we know that companies have been really beefing up the technology side as more people are working from home and trying to make sure that the technology will support that remote operating environment. But here's kind of a quick look on the consumer side and what people are buying. Interesting, and maybe not too interesting, but not too surprising certainly, is the investments that individuals are making in smartphones, laptops, and televisions. Really strong rates of growth there. And then you also see from a smaller base, I mean, kind of health, small, smart home, and even kind of personal fitness, gaming, e-toys, those things kind of perking up at pretty large percentage gain numbers. So I thought this was really interesting, just to show that that consumers are really stepping up their spending in 2021. That will do it for this week for the chart pack and charts of the week. On behalf of the entire team at BKA Wealth, hope you have a wonderful week, safe week, and we'll look forward to seeing you again soon. Take care. Goodbye.